Welcome, everyone. Today, we're diving into one of the most fascinating and influential market structures in economics, oligopoly. This market structure features a few dominant firms that wield significant control over industries, shaping pricing, production, and innovation on a large scale. From smartphones and automobiles to energy sectors, oligopolies influence our choices as consumers and play a critical role in business strategies. During this session, we'll explore the meaning, characteristics, causes, effects, and pricing models of oligopoly, all illustrated with real-world examples to make these concepts both engaging and relatable. Let's get started. Meaning of oligopoly. An oligopoly is a market structure where a few firms dominate the majority of the market share. These firms are interdependent, meaning that the actions of one firm affect the others. For example, in the mobile phone market, companies like Apple, Samsung, and Huawei lead the industry. If Apple introduces a phone with innovative features, Samsung often responds with a competing product. Despite their competition, these companies usually maintain stable prices to avoid price wars that could hurt profitability. Characteristics of oligopoly. 1. Few dominant firms. Oligopolies are defined by a small number of firms that control the majority of the market. For instance, the automobile industry is largely dominated by players like Toyota, Ford, and Volkswagen, whose decisions have a far-reaching impact on the industry. Number 2, interdependence. Firms in an oligopoly are highly interdependent. Any price change, product launch, or strategy by one firm influences the behavior of others. For example, if Delta Airlines lowers ticket prices, competitors like United Airlines and American Airlines may follow suit to remain competitive. 3. Barriers to entry. High barriers to entry protect oligopolies stemming from significant capital requirements, economies of scale, or strong brand loyalty. The telecommunications sector exemplifies this, with giants like Verizon and AT&T maintaining dominance due to substantial infrastructure investments. 4. Product differentiation or homogeneity. Oligopolistic firms may offer either differentiated or homogeneous products. Differentiated products. In the smartphone industry, brands like Apple and Samsung differentiate themselves through features such as camera quality, software, and design. Homogeneous products. In contrast, the oil industry, led by companies like ExxonMobil and Shell, largely deals in crude oil, a uniform product. Price rigidity. Prices in oligopolistic markets tend to be stable, as firms avoid price wars. For example, Coca-Cola and Pepsi rarely engage in significant price changes, preferring to focus on promotional strategies and advertising campaigns. Causes of oligopoly. 1. Economies of scale. Large firms gain cost advantages through large-scale production. For example, Toyota and General Motors manufacture vehicles more efficiently than smaller competitors, giving them a significant edge. Number 2. High barriers to entry. Industries like telecommunications require massive capital investment and infrastructure, discouraging new competitors. Established players like Verizon and AT&T benefit from these entry barriers. 3. Mergers and acquisitions. Mergers consolidate market power and reduce competition. A notable example is the merger of Pfizer and Warner Lambert, which created a stronger pharmaceutical entity, allowing them to dominate the market further. 4. Mutual interdependence. In an oligopoly, firms are constantly influenced by each other's decisions. For instance, if one airline introduces discounts, others quickly follow to remain competitive. Effects of oligopoly. 1. Small output and high prices. Oligopolistic firms tend to produce lower output while maintaining higher prices. For example, airlines often limit flights on key routes to sustain high ticket prices. 2. Restriction on entry. High barriers to entry ensure that established firms maintain their dominance, leaving little room for new competitors. In industries like telecommunications, firms such as Verizon and AT&T maintain dominance due to high infrastructure costs. These barriers discourage new entrants and help existing players retain their market position. Prices exceeding average costs. Oligopolistic firms often charge prices well above production costs, generating significant profits. For instance, pharmaceutical companies like Pfizer price patented drugs at a premium, ensuring high profitability. Price competition. Instead of engaging in price wars, firms compete through advertising, product quality, and innovation. For example, Apple and Samsung emphasize branding and introducing new features to attract customers rather than lowering prices. Price determination models in oligopoly. One of the most notable models used to explain pricing in oligopolistic markets is the Kinked demand curve model, which illustrates why prices often remain stable. Elastic portion, upper curve. When a firm raises prices, customers switch to competitors, resulting in elastic demand. Inelastic portion, lower curve. If a firm lowers prices, competitors often respond by doing the same, leading to minimal changes in demand. For example, if a smartphone manufacturer increases its prices, customers may choose alternatives. On the other hand, if the same firm cuts prices, competitors quickly follow, which limits the impact on market share and keeps prices relatively stable. Cartel theory in oligopoly. A cartel is a formal agreement between firms to reduce competition and maximize collective profits. This is typically achieved through price fixing, output limitations, or market sharing agreements. A prime example is OPEC, Organization of Petroleum Exporting Countries, where member nations collaborate to set oil production quotas, influencing global prices. By coordinating their actions, OPEC ensures stable and high oil prices, benefiting its members. However, cartels face challenges such as non-compliance by members and competition from external players. Conclusion: oligopoly is a dynamic market structure that shapes industries worldwide. While it provides advantages like economies of scale and fosters innovation, it can also lead to inefficiencies, high prices, and limited competition. Understanding oligopoly helps us appreciate how industries operate and how firms develop strategies to remain competitive. Thank you for joining this discussion on oligopoly.